Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, Canada's flirting with a recession, but is it serious? And ag is big business in Canada, but how can it be even bigger? Plus, is China a viable plan B for Canadian exports? That's all ahead. First, for the week that was in business, it's time for the briefs. The province of Quebec has declared the Northvolt battery project dead and will write off $270 million it invested in the venture. It's been the subject of speculation for months after Northvolt declared bankruptcy in Sweden in March. Quebec had pledged up to $510 million in the projects with the hopes of creating 3,000 jobs. Food giant Kraft Heinz will split back into two separate companies about 10 years after merging. The combination of powerhouse brands was backed by Warren Buffett and Brazil's 3G Capital in 2015, but failed to create promised growth. It's not clear what, if any, impact the split will have on the company's Canadian operations. The price of gold hit an all-time high this week, above $3,500 U.S., as global investors seek out a safe haven against inflation and geopolitical risk. Some central banks are adding gold to their holdings and selling U.S. government bonds, a signal that the safety of that U.S. investment is in question. Nestle said it has fired its CEO for what it calls an inappropriate relationship with a subordinate. Laurent Frex denies wrongdoing, but Nestle is denying him any severance all the same. The food and drink giant fired its last CEO a year ago after concerns about Nestle's performance. Canada Revenue Agency has been given an order to create a 100-day plan to fix quality issues at the tax agency. Service delays and access issues at CRA call centers prompted the finance minister to issue the directive. It comes after a scathing report from the federal ombudsman on the quality of service. CRA cut thousands of jobs in the past year. And those are your business briefs. Canada's economy is clearly feeling the effects of ongoing U.S. tariffs, and business confidence is down. So how gloomy is the outlook? Pedro Antunes is chief economist at the Conference Board of Canada. Thanks for being with us, Pedro.
It's a pleasure. Thanks for having me.
So let's start with this question of, is a recession inevitable?
Well, I think we're pretty close to what we call a technical recession, in the sense that we've already heard from Statistics Canada the second quarter just last week came in quite strongly negative. It was down at an annualized rate of 1.6%. So, when you think about Canada's economic growth, a normal pace of positive growth is around 2%. So we've got a quarter here that came down 1.6% in the second. Plus, we've got a number of indicators that are suggesting that the third quarter is going to be flat at best. We know the labor markets aren't doing well. We've got some indicators on monthly industry basis that are telling us that we may very well be flat or slightly negative in the third quarter. So technically, we're in a recession. I think the pain is already here. We've seen labor markets not create any jobs since the start of the year, really. And we're seeing the pain all across in terms of consumer confidence, being at very low levels. Business confidence down as well. Just all of this uncertainty created by this trade and tariff war.
Yeah, it seemed clear that export was really where we saw the real pain. Business confidence, of course, terrible. You mentioned consumer confidence. It did feel a little bit like domestic demand was holding up. But it's not enough, I guess, to offset all of these other big issues that are the headwinds for our economy.
Yeah, I mean, the big hit to the second quarter, of course, was exports. We, in fact, had a ramp up in exports in the first quarter of the year, as essentially firms were trying to get ahead of the tariffs. The second quarter, though, we're seeing the reality of these tariffs. In fact, a number of industries are going to see exports now well below their normal levels, even before, comparing to before the spike up in the first quarter. So we're going to take a hit from that. The other pieces you alluded to, I mean, business confidence is very low, and that is already having an impact on investment. And in fact, investment in the second quarter was down sharply as well. That's really bad news for our future productive capacity and our future job creation. But you're right, consumer spending, even though consumer confidence is also at very low levels, consumer spending has held up. And, I attribute that a little bit to the fact that wages had finally caught up with inflation. And we have seen with a number of measures, essentially household incomes, real incomes, if you'd like, in other words, incomes above inflation held up. And one of the big factors there, of course, is the carbon tax coming off of inflation, getting those numbers down back to below 2%. So that has been good news for consumers. But I don't know that that's going to last given the uncertainty around jobs.
Fair enough. We've got the Bank of Canada, of course, only a couple of weeks out from a decision. I'm seeing sort of 50-50 on whether they lower rates. And maybe it's because we're seeing things like wages and some other prices remain elevated, and that's inflationary. But would all this add up, as far as you're concerned, to the need for a bit of a rate cut to help stimulate?
Yeah, I do think the bank has been quite prudent. I think they're holding some fodder just in case the economy goes really bad and they do need to lower rates below neutral, let's say. The bank has told us in the past that their neutral rate is pretty much around where they are right now. So we could see another quarter basis point drop in September, especially given the weakness in the economy that we just saw. Whether the bank continues to drop its rates and go below neutral, that'll depend a lot on the state of the economy and whether we do start to see a recession or deeper recession or job losses, things that are really painful for consumers in this country. But I think the other piece that's really important here is even as the bank has lowered rates over the last year or so, when we look at the market rates that consumers pay that are mostly based on bond yields, 3-year bond yields and 5-year bond yields, those haven't come down a whole lot. And we do know that there's an awful lot of households that are turning over their mortgages, that are renewing their mortgages from very low rates that they got in 2020 and 2021. And that is still yet to have some pain on households. So that's why I say that, we are seeing some consumer spending holding up right now. But I think we are going to see more pain from essentially higher rates and higher debt financing.
We have to leave it there, Pedro. So good to have your thoughts on this.
It's always a pleasure. Thanks for having me.
Pedro Antunes is chief economist at the Conference Board of Canada. Coming up, Canada's agricultural sector is big, but are we missing the opportunity to make it truly world-class? Stay with us. Welcome back. As Canada turns its attention to nation-building projects, one of the sectors with the biggest potential might be right under our noses. Here's a look at the potential for agriculture by the numbers. Ag and the agri-food system are a big chunk of our economy already, at about 7% of GDP, generating just shy of $150 billion in annual revenue. 2.3 million Canadians are employed in ag, spread across primary agriculture, food and drink processors, retailers and wholesalers, food service providers, and input and service suppliers. At the end of 2024, there were 189,874 farms across the country, covering 6.2% of Canada's land mass. The average farm has doubled in size in the past 50 years. Farm receipts alone were worth $92 billion last year and grew at 5.1%. Bigger is better in farming. The largest 10% of farms generated 2/3 of all the revenue. Exports matter a lot, too. Canada exported $100 billion of food products last year, making us the 9th largest in the world. The U.S. is the top destination, and China is in second place. Chinese tariffs on canola, peas, pork, and seafood have hit hard. But our domestic market matters, too. Canadians spent $213 billion on a combination of food and beverage, tobacco, and cannabis last year. It's the 3rd largest household expenditure behind shelter and transportation. Growth in ag will come through innovation. Farm Credit Canada, a government-backed organization, is pledging $2 billion by 2030 invested in advancing the ag tech innovation space. Justine Hendricks is president and CEO of Farm Credit Canada. Justine, thanks for being with us.
Thanks for allowing me to be here.
So it's this massive sector. We know it's important. There's been a lot of talk over time about making it more world-class, increasing our exports. What do you see as the best way to support that?
Well, Amanda, as you and I have talked in the past, this sector is facing right now what we call a generational opportunity. So it's got an opportunity to solve 4 major problems: health, hunger, climate change, and be a huge driver of economic growth. And what's super important, I think, for the audience to hear is that it can actually do that all at once. And part of being able to do that, as we've been hearing lots out there these days, is how can we also enable it, whether it's the right infrastructure, irrigation, whatever it takes, both at the domestic side and into the export side, to be able to, for the sector to really drive into maximizing its productivity.
And you've got this mandate, right, for a couple of $1 billion of investment in the sector. Will that be hard to do in the sense that it may be a large number of small investments?
So we don't believe that it's going to be hard to do. And we've got evidence that's also indicating to us that as we've been putting some money out in the sector, as you know, it's important to be able to attract the private sector as well. So I can share with you that right now, for every dollar we're putting out, FCC is actually able to attract $3 from the private sector side. So it's only the beginning, but we certainly see that as a really good sign.
Of course, we are seeing a lot of the folks in this sector, especially, of course, in parts of ag. Canola comes to mind, pork, some seafood, that are still really struggling with tariffs. Is there help to be had there, or are we looking kind of beyond that at how to innovate on the other side of it and grow our exports?
So, Amanda, I'd say there's a bit of both, right? So from the help side point of view, last week, FCC launched a program in order to support those in the canola sector. And what's important with that program is we really customize on a per customer basis what's needed in order to help them weather this storm. But also, as we know, the Prime Minister's just announced that his Secretary, Cody Blois, is going to be going to China to be able to see and to attend to the issue around canola. So we're very much looking forward to that, and we're here to support.
I should ask you, we know that some parts of our agriculture sector is under threat, including our supply management systems. Are farmers worried about that there will be changes in the years ahead?
So we actually track on a bi-weekly basis ever since this past January. What's the sentiment across Canada? I tell you, Amanda, it's varied. I couldn't say that people are not worried or concerned. We're monitoring it super closely. But of course, as different announcements come along, we do see that trend line oscillate up or downwards. And again, we're keeping close contact to be able to see how we can support.
Are you optimistic about the future? I guess it's partly your job to be so.
I am, Amanda, over and above the fact that it's my job. Like I said, we've been working on quite a bit at FCC, whether it's some of the investment envelopes, we're going into some of the AI aspects of it and trying to design some new tools to bring value. And I must say, I travel quite extensively across Canada, and I would say the customers are really eager, and there is a sense of optimism, but also an awareness that we've got to navigate the next few months and perhaps years very carefully.
Justine, thanks so much for being with us.
It's my pleasure, Amanda.
Justine Hendricks is President and CEO of Farm Credit Canada. While the agriculture industry looks to innovate, a massive wave of retirements will also hit the sector, and too few farm businesses are investing in themselves. Yves Millet is CEO of Farm Business Consultants. Yves, thanks for being with us.
Thank you. Happy to be here today.
So this sector faces the same demographic shift as others, but with a slight difference. It's not as easy, you might think, to sell a farm business as it might be to sell a different business. They're very specialized. How big is the situation? How big is the problem of this kind of generational transfer that's headed our way?
Well, it's estimated that 40% of the farmers are set to retire in the next 10 years. And that this represents a multi-trillion-dollar asset transfer. So it's very interesting.
And of course, it's one of those times when people might actually get some financing to purchase and make new investments. Are farm businesses thinking the way they should about how to invest in themselves, new technology, new ways of doing things?
Well, first of all, farm businesses are actually quite entrepreneurial, and they do invest in technology. Some 75% of the farms are investing in technology of some sort. But if we were to speak to today's investment trend, very few are investing it's been 4 straight years of economic challenges from a profitability perspective. So whilst the farmers are asset rich, they're cash poor. And so their cash flow is challenged. They're putting a lot more purchasing power into just optimizing the yield of their crops and frankly trying to repair the equipment they have, and if they can, looking for used equipment. So they're being very careful with how they invest their money.
Yeah, as entrepreneurs do. This, of course, all happening at a time when there are some very high-level issues hitting the whole sector, the whole country. But for ag, of course, we have, some farmers are dealing with specific tariffs that are still weighing on them, making them rethink which crops they're going to plant and where they're going to sell. How does that factor in when they're also trying to think about making important decisions about investing in things like AI and efficiency?
Well, I think they're perpetually balancing all of those factors. And so AI for them, by and large, the way a farmer would access AI is through their vendors, through their suppliers. And those are the people that are innovating with AI. And those in turn are being applied to things like their crop planning, their, irrigation, all of the things. And the estimates that are important to a farmer, the estimates are that AI-enabled improvements are generating somewhere between 750 million and 1.5 trillion dollars of improvement in the farming economies in Canada alone.
So good to have you for this, Yves. Really appreciate your time.
Well, you're welcome.
Yves Millet is CEO of Farm Business Consultants. Coming up, how should Canada approach China as our trade tension with the U.S. continues? That's still ahead. But first, Crown Royal recently said it was rethinking its North American footprint and will no longer bottle the Canadian whiskey in Ontario, shifting it instead to the United States. The whiskey was introduced back in 1939 to commemorate the royal tour of King George VI. The decision to move production south prompted a strong reaction from Ontario's Premier Doug Ford, who theatrically dumped a bottle of the booze in a show of outrage. We're not sure what that accomplishes, but it was a royal tantrum. We're back after this. Welcome back. While our relationship with our largest trading partner remains tense, many are looking for opportunity in China. And while engaging there does make sense, sometimes in some ways, Canada has to be clear about serving its own interests. Van Hampson is co-chair of the expert group on Canada-U.S. relations. Van, thanks for being with us.
My pleasure.
So let's start with, on a week when we're seeing China literally lining up with Russia and North Korea, it sounds funny to be saying, how do we do business with China? But it is a massive economy and we do some trade with them already. What's your advice on how to do that well?
Well, Canada is clearly at a crossroads now, Amanda. The U.S., historically our most important trading partner, is shutting us out of its markets. And ensuring Canada's prosperity now means actively diversifying our economic relationships with other countries, including China, which is already our second most important trading partner. And in the report that the expert group on Canada-U.S. relations issued, we argue for a strategy of selective engagement, which means doing business with China, but doing it carefully, doing it strategically, targeting cooperation in areas where it's clearly to our mutual benefit. And that's, selling more to China, particularly when it comes to energy and agricultural exports.
Can we walk that line? I mean, of course, it's a big, compelling market for us. But in terms of protecting ourselves against what can be seen as a hostile state, Fen, do we have the tools we need to protect ourselves? Well,
I think it starts with diplomacy. I mean, there's no question that the Chinese have weaponized trade. They've recently imposed, very high tariffs on our canola exports. And that means, doing a restart on the relationship that starts at the leadership level, which is going to be all important. Prime Minister Mark Carney has already signaled, in fact, he signaled yesterday he'd like to do more business with China. But that's not going to happen until he sits down with Xi Jinping. There'll be an opportunity to do that at the end of October at the APEC summit, perhaps have a sidebar meeting with them. But I think we also have to recognize that it is ultimately in China's interest to do business with us. They're also interested in security of supply. That's true in the energy sector. It's true in agriculture. Their tariffs on canola, Amanda, have led to shortages in China, and prices are going up.
Yeah, hopefully everybody knows that it's in our interest to trade freely, or as freely as possible. We don't have a ton of time, but would we be thinking this way about China if the U.S. weren't behaving badly? How much of this is just practicality? We need to trade with somebody.
Well, we need to obviously diversify trade. I mean, I would have argued we should have been doing that before Trump came along. Trump is the latest iteration of greater protectionist policies south of the border. So diversification, and certainly with the biggest market right now in the world, which is China, and we have things we can sell to them.
Fen, so good to have you. Appreciate your time today.
My pleasure.
Fen Hampson is co-chair of the expert group on Canada-U.S. relations. Time for the takeaway and taxing the robots. A proposed new server tax in Alberta is raising eyebrows and questions about how to capture value in a digital economy. The government will launch a 2% levy on hardware in data centers that are connected to the power grid come the end of 2026. There was an immediate chorus of foul play, along with arguments that such a move will hinder investment in a fast-growing sector. And for sure, it might do that. But maybe that's okay. Maybe it's even the point. Back in 2017, Microsoft's founder, Bill Gates, mused about a so-called robot tax. The idea was that as we continue to automate more and more functions of our production of goods and services, human beings will become less and less necessary. Meanwhile, the cost of production after the initial investments in the new robots will fall. So while profit rises, jobs will shrink to nothing. It's a picture that's even clearer now that artificial intelligence is alive and walking among us. Far from just robotic arms on manufacturing lines, AI can replace white-collar workers like lawyers and doctors. Gates' thinking was that taxing the robots helps redistribute income, since the robots are putting us out of work. But it was also clear that slowing down the pace of change was part of the appeal. No one will argue that slowing down the creation of new data centers is a worthwhile goal, if only because what isn't built in Alberta will surely be built elsewhere. But recognizing some of the broader costs of these centers, including the extent to which they will draw down overburdened electricity stores, makes good sense, even if the tax is only used to fund the creation of more electricity. Otherwise, the grandmother in Medicine Hat will be paying exorbitant rates to heat her home so that Google can run its AI through servers hooked up to Alberta's grid. My takeaway? Taxing big consumers of electricity could be only the start of a new way of thinking about where the profit is being generated and at whose expense. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.